Hi, and welcome to this property accounting discussion with Evolve Accounting. So, without further ado, let's kick in and just sort of have an overview of what we'll go through today. So, first I'll start off giving you an introduction about myself, and then just have a bit of a talk around property investment goals. I want to cover off some taxes 101 and property tax 101. We'll talk about some investor tips and tricks that you should keep in mind, and then start having a look at some of these property tax law changes that came about this year. Lastly, we'll finish off with a bit of a conversation about structures. So look, myself, I am a chartered accountant and public practitioner and owner of Evolve Accounting. We look after businesses throughout the whole of the property sector, to be honest. We've got architects, we've got builders, we've got tradies, and from that we then have property investors, developers, mortgage brokers, real estate agents, so basically that whole property sector, in addition to other types of businesses as well. But property is our mainstay, and I think that's because it's part of the psyche of us as New Zealanders. It is a part of all of our lives, and what I like to do is try to understand what exactly the reason it is behind the property activities, and how does that fit into your larger goals of what you're working towards. And that's really what I enjoy and understanding about in the property sector. And so that really leads on to your property investment goals and kind of having an understanding of why are you getting into property. Is it about retirement? Is it about investing so that you can create equity to then ultimately pay down the mortgage on your home? Will you be assisting your kids in the future? Is that a goal for you? And with that, what are your time frames, and how big do you want your empire to be? Because that also then leads into how much risk you need to take on. If you're aggressively trying to grow a property portfolio, it becomes increasingly difficult because of serviceability. And so that might lead you to then start looking at alternative means of finance, and how will you deal with that and approach that, and guide yourself through that. So if you can understand those, and sort of develop a bit of a plan, then that'll help you tackle your property empire. And it doesn't need to be too complicated, but having someone like your accountant who understands what you're trying to get to, where you're trying to, on what kind of time frame, can really help you along that journey, because they can help you work out what are some of the roadblocks you're going to face, and try and preempt them before they come up. So look, just want to have a bit of a chat around taxes, because there's a lot of names for taxes out there, and I just want to cover off the basics. So the three core taxes that you probably hear about are income tax, provisional tax, and GST. And when it comes to income tax, it's broken up into a whole lot of different names. Provisional tax and terminal tax apply to business owners. They are all one the same thing, as is PAY and withholding tax for employees or contractors. These are all income taxes. They're just different means of how you are paying that tax. Excuse me. So it all just sort of falls under that income tax umbrella. And then with the tax rates, the personal tax rates are 10.5% through to 39% for income over 180,000. And that compares to a company that has a flat tax rate of 28% and trusts at 33%. Now you might look there and say the company tax rate of 28% looks pretty good. We should put all our stuff through companies. But what I will say is that a company tax rate at 28% is a temporary tax rate. As soon as you try to take the money out of the company, it has to come out via way of a dividend, and at that time you end up paying tax at the receiver's end. So if you're an individual, that could be 33 to 39%, or if you're a trust, you'll pay tax at 33%. Now, thing to know around record keeping, yes, you do need to hold those records for 7 years, and those receipts and invoices should be legible as well. They often fade with time and in the sun, so keep them somewhere safe. And what I would say to that is maybe save them to your computer, scan them, or whatever it might be. It doesn't matter how you do it, whether it's on the computer or in hard copy, just make sure you do have those receipts. We as accountants will use modern accounting systems like Xero. It attaches up to your bank account to sort of capture all the transactions that are going on. But ultimately, the record keeping of the physical record behind that is the responsibility of you as the taxpayer. So just make sure you've got those all handy. If you don't have the receipt, technically you shouldn't be claiming. And what I will say is always really good to set aside a particular folder or some sort of system for those sale and purchase agreements and major documents, because you'll be surprised how often they get pulled upon many years after the fact. So easy retrieval, make your life easy. So let's get some fundamentals around property tax underway. There are two distinct pictures when it comes to property tax. You've got the rentals and you've got the buying to sell, or trades, flips, renos, however you want to call them. So with a rental, you've got an intention to rent out the thing long term. Outside of the bright line test, there is no capital gains tax, and there are some quite large limitations on the types of expenses that can be claimed. Whereas if you are in the business of buying and selling or renovating a property, then all the gains that you make are taxable. In that instance, you would be GST registered for that type of activity. It's considered a business activity, and also most of your costs that would relate to that type of activity are tax deductible. This compares to a rental property, which is exempt from GST, and then, like I said, has those limitations on what costs can be claimed. But that's not the only thing to distinguish when it comes to property, because there is a whole lot of property tax laws out there. Now, the most common one that we know in the, I guess, the media talk about the most is the bright line test. That is, if you buy and sell a property within 5 or 10 years, except the family home, you will pay tax on the capital gain made. But there are also a raft of other property tax laws out there. You've got the intention test that covers off, what was your intention when you purchased the property. That can come about because the ID may think that you need to pay tax on a particular property, and they might request conversations you've had with the bank, financiers, or other people around what you're doing, and that's usually come about because they've seen a pattern of activity that they think that you have originally purchased that property with the intention of resale. So in those situations, you will be taxed. Then you've got your dealers or flippers. We talked about them on the previous slide. Oh, sorry, I've jumped ahead. You've got the subdivision, and this is a real tricky area. If you are subdividing, you need to get tax advice because there are so many twists and turns when it comes to the subdivision tax laws. But basically, if you are undertaking a subdivision, it's quite possible that tax could apply. There are rules around if it's less than 10 years or in terms of ownership, or whether it was after 10 years. There's ins and outs depending on if you've got your home or if it's for investment. Lots of things going on, so just be aware. If you are a dealer, then yes, we talked about that on the previous slide. Look, you're going to be paying taxes as you go on the profits that you make. But in addition to that, you've got to be aware that there's this thing called tainting, and that is if you're sort of in property development, but you're also getting investment properties at the same time, your development activities taint your property investments. So you can have a scenario where you buy a property investment and it's tainted, and if you sell that within 10 years, you'll pay tax on it. It's completely separate to the bright line test. So we're going to talk about bright line later on, and we're going to talk about new builds having a 5-year tax rate rule, but this tainting provision would mean 10 years applies to a particular property. So if you're doing a bit of flipping, trading, then there are other things that you need to take into account as well. The rezoning aspect of the Income Tax Act is an interesting little one and quite relevant for The Auckland market, and I think in general, where we've had the Auckland Unitary Plan come out and say, you can intensify and subdivide and all these kind of things. If you're not caught by, for example, the subdivision part of the Income Tax Act, you could still be caught by the rezoning provision. Basically, if your land gets rezoned because the council allows it to be rezoned, or you apply for a resource consent and it is granted, and that price increase in the value of the land is greater than 20%, and that's also sold within 10 years, then you can be taxed on the gain that is made. So quite an unknown part of the tax law. Doesn't get used all that often, but is there, and particularly relevant, like I say, for Aucklanders. Interesting to note, just in the last week or two, the government's come out and said you can intensify, up to 3 stories and how many properties on your land without having to obtain a resource consent. That's particularly relevant to this rezoning provision, because a lot of the rezoning provision here is to do with having to obtain resource consent. So the fact that you don't have to for these new intensifications mean this rule was less likely to apply in those situations. And then lastly, builders have their own rule. And a builder is quite wide. It's not what you think, the construction company, builder or building owner undertaking, his kind of building activities. It also applies to someone who's got a bit of land and, just old Joe Blogs, and you decide to put a couple of properties on there to sell. You're classed as a builder. And with that, your building activities will be taxed. And in addition, it can also be akin to a tainting impact that I talked about before for dealers. It can impact your other property portfolios. So things to think about there. And like I said, property tax is a minefield. So if you're getting into any sort of transaction, you should definitely seek advice. Now, some tips and tricks for investors. If you're buying a property, go get a chattel depreciation. Valueit's probably one of the most well-known outfits out there for getting those. They'll go through and have a look at your property and work out the value of your chattels, and from that you'll be able to depreciate them. Now, growing your property empire needs to be done from somewhere, so you can do a home office claim. This is claiming a percentage of your home as a tax expense. So common scenarios, the bedroom becomes the home an office to run your property empire, and that works out to be 12% of your area of the property. And so with that, you can claim 12% of your electricity, or 12% of your rates, insurances, interest on your mortgage, or rent, depending on your situation. So it's just an additional tax claim that can be made. As is mileage. So if you're having to travel to your properties to check on them, maintenance, whatever it might be, then that travel to and from the property is tax deductible. You need to keep a logbook of your kilometres that you travelled, and an odometering at the start and the end of the year, and you'll be able to make that claim. Now, that claim's usually around, it fluctuates year to year, but it's around about 80 cents per kilometre. Debt structuring is particularly relevant, or was relevant. You really wanted to make sure you got your debt correct so that you could maximise your tax deduction, with it being the largest expense. With the denial of interest on some types of properties, this may seem like it's less relevant, but what I would say to that is you still want to make sure you get your debt structured as if you could claim. And the reason for that is tax laws come and go. And you might find that when the next government comes in, they change the rules back or to something else. And, depending on how you're structured, you could be in or out. So always try and get your debt structuring as correct as possible. And, when I talk about debt structuring, that's talking about what entity owns what debt. Where did that deposit come from? How did it get repaid? All those types of things come into debt structuring. Repairs and maintenance is a bit of a minefield. Lots of case law, lots of interpretation standards from the idea about what is a repair versus an improvement. And look, it is grey, but what I would say to that is sometimes it's worthwhile having a conversation with your accountant and, just talk about what your repairs that you are looking to do or the work that you are trying to do. And it might be that maybe an invoice from the builder can be drafted up in a certain way that it looks like repairs and maintenance, or maybe split out the type of work that is being done so that one part of it can be clearly identified as repairs, whereas another part may be improvements. The distinction there being repairs, you get a tax deduction on; improvements, you do not. They're considered capital or part of the property. You can't claim those. So to the extent we can push things into repairs and maintenance, the better it will be for you. So as we know, it's been in the media quite a bit, there were two key tax law changes that happened this year. They were the Bright Line tax rule changes and interest deductibility changes. So I'm going to consolidate all the noise that has been in the media and that you've read about, and just sort of run you through what exactly it all means. Now, the definition of a new build is relevant for these rules because we've got two classes of property. Now, we've got new build and what's called disallowed residential property. So a new build is a property that obtains its code compliance certificate after the 27th of March 2020, so that's last year, and adds to the housing stock. So it doesn't have to be a new build per se, a new dwelling, but it could be a relocatable, build a new minor dwelling or put a minor dwelling on a site that is going to classify as adding to the housing stock and would require a CCC, so would meet the definition. As does converting a commercial to a residential residence. So that's the definition of a new build. And so when it comes to interest limitation rules, what is out of the rules is really important. So what isn't in the interest limitation rules? So this is the interest limitation rules are you cannot claim interest. Okay, so outside of these rules are new builds, so new builds can claim interest, as can commercial properties, but with an exception, not short stay accommodation provided in a residential dwelling. What that pitch there is at is batches that are rented on Airbnb, for example, short stay. In one aspect and other parts of the tax law, particularly GST, that is a business activity, and what they're saying here for income tax purposes is that kind of scenario is completely different, and it falls under these definitions of residential property, not commercial. So they say for commercial properties, yes, you can still claim your interest, but not the sort of subset of batches being rented out for short stay accommodation. Hotels and the likes also don't get caught by these rules. Neither does the main home. The main home generally doesn't get caught by interest limitation rules anyway, because you can't claim interest. But there are a few scenarios where that might come about. So I just sort of said it doesn't apply in those situations. Property developments not part of these rules either, as are retirement homes, employee student accommodation, farmland, land outside New Zealand, and Maori collective owned land and housing. Now I've put in red there emergency, transition, social and council housing, because what I have seen is with these rules coming out is a lot of talk and people looking to now rent their properties out to Kaianga Ora or other social housing providers to get around these interest limitation rules. So the existing dwelling, that rental property that they might have is going to lose its interest deductions, and so what they're looking to do is now rent it out to social housing providers so that they can continue to claim that interest. Something to think about. Definitely pros and cons. So look, breaking down all of these rules, what we've got is we've got this terminology called disallowed residential property, or DRP, and your new build property. So 10 years for existing property versus 5 years for a new build. If you purchase that existing property after the 27th of March, you'll get no interest deduction on that property. However, if you still had that property, or that property was acquired before 27th of March, then you've got a phasing of interest deductibility that kind of disappears over the next 5 years. Now, on a new build, you do get to claim the interest, but there is a limitation. It's only for 20 years. So you can see some sort of register is going to have to be kept of when CCC was obtained and when that expires, on the accounting side, so that interest deductibility can be recorded correctly. And then on the main home side of things, main homes normally are not caught by the bright line test, but if there are periods where you rent out the property, that will be caught by the bright line test. And so there has been some changes in this area, and so basically, if I was to use the example, lived in my home for 3 years, then I rented it out for 2 years and sold it. For 2/5 of the capital gain that I make, I'm going to now be paying tax on that. And that was different under the old rules. And in the old rules, I had not rented it out for more than 50% of the time, so I didn't have any bright line tax. Whereas now they've made it more proportional. And there is a distinction here between what is a new build family home and an existing property family home. So I thought that was quite interesting to see that they've made that kind of distinction. So what do the accountants think? Well, definitely a lot more record keeping is going to be required. Property by property, loan by loan, tracing, it's certainly going to increase the amount of time that it takes to work out what's going on each property. So with that, obviously, that's going to increase costs, unfortunately, and particularly where you've got a mix of new build property and existing property all owned in one entity, because there's going to have to be carve-outs and, looking at each individual property separately. It's going to be interesting. So anything other than a straightforward sale and purchase is going to have a number of factors to consider. So now what I've got up here on the screen, what I want to talk about is, let's just have a look at the numbers, because as investors, it's always on the numbers, right? So you can have tax law changes, but what do the numbers actually mean? And so I want to look here at an existing property, as they call it, disallowed rental property, versus a new build. And the existing property is an older house on 800 square metres, so it has subdivision potential. And so with that, I've given it a capital growth rate of 3%. It doesn't matter whether it's 3%, 5%, it's just used for comparative purposes. I'll put the rental growth rate on that one at 2% and the repairs and maintenance at 7% of rent. So in this scenario, it has a diminishing interest deduction. It should say to nil by 2026, not 2025 there. Versus the new build. So this is a newer house. It's on 400 square metre section. It does not have subdivision potential. Okay, so I've brought down that capital growth rate, compound capital growth rate on that property, because there's no pent-up value in that land for the future. It can't be broken up into smaller portions. The rental growth rate I've put a little bit higher at 2.5%. It's a newer property, more desirable to live in, warmer living, all that, healthier, all those kind of things. And also repairs and maintenance down a little bit to reflect that it's a newer property. So yes, wear and tear has occurred. And you also get a full interest deduction on a new build for 20 years anyway. So let's sort of graph what that looks like. So this is a graph over 10 years, and this is looking at the combined net growth rate. So that includes the capital growth rate and the residential, the rental income stream, including your taxes that you're going to have to pay. So taking these two into account, you can see that new build property just edges above the existing property over a 10-year period. And you see there's a bit of a crossover there at year 7, or in this case 2028. So that's quite interesting. They're very closely aligned, not a lot of difference in it in our scenario. Now remember, it is just a scenario and variables were chosen there, and it's not hard for things to move by an additional 0.5% or whatever it might be. So let's have a look at what that could look like if it's 0.5% in the existing property's favour. So now I'm having a look at the existing property with a growth rate of 3.5% versus the new build's growth rate of 2.5%. And that's not out of the realms of possibility where you have property that is in a desirable location that then has subdivision capabilities. That the demand for that type definitely can go through the roof. We've seen that in this property cycle. And so have a look at that. You see that the existing property, or DRP as it's called, has significantly higher growth than the new build property. So what's the food for thought on that? The food for thought is do it on the numbers. If you've got existing property that has some future potential in it, it's worthwhile considering what that future potential might be, and sort of modelling it out. But it could be, if it's got subdivision potential, might even be worth incurring the fact that you do not get to claim interest on that property for the fact that you could subdivide it in the future. And you've got to survive through that future. So when we talk about loss of interest deductibility on a 500k mortgage at a 4% interest rate, that's an additional 6,600 of tax you'd be paying in a year. And on an 800k mortgage, it's 10.5 grand a year. You've got to be able to cash flow this and pay this as it goes throughout the years. So you've got a bit of a negative cash flow scenario, certainly on the tax side of things, when it comes to this kind of analysis, and you need to be able to fund that, throughout your period of ownership. So looking at graphs, you can get carried away and think, oh yeah, this is the way. But remember, you've got to live in the present and pay for things year in, year out. So just bear that in mind as well. Certainly these interest changes are going to have a big impact on people. There's plenty of investors with an 800k mortgage having to pay an extra 10.5 grand in tax a year is significant. So lastly, I just want to talk about structuring. So when it comes to structures, there is a myriad of ways you can do things. You've got sole ownership, and then we lump in together partnerships, joint ownership, tenants in common, all very similar to each other. Got companies, and then look-through companies. And then lastly, we've got trusts. When it comes to companies aren't really set up to own residential property investment, and that is why there is a particular type of company called a look-through company. Its predecessor was an LAQC, and then they turned into LTCs. It must have been 10 years or so ago now. They are more geared for property investment because they have particular rules that are advantageous for property investors, particularly when a property is sold, that you don't get in a normal company. In a normal company, if you sell a property, you might actually find yourself in pulling the money out. You might actually find yourself with a bit of a tax bill. So look-through companies sort of give a couple of benefits to property investors. And so what's going to be appropriate for you is going to come down to your situation. If you've already got a trust, or do you have a split family scenario? Do you have businesses? Is it your main home that's becoming a rental? Lots of things to consider before deciding what is the most appropriate structure for you. So what I would say is don't go to a barbecue, hear what your mates got in terms of structures or what planning to do, and think that's going to apply for you. It's going to come down to your situation, what you're trying to achieve, like I said, your existing structures and personal circumstances. So definitely need to seek professional advice when you're doing that. So I hope that's given you a whirlwind quick update on just sort of things that you need to think about when it comes to property, as well as those tax law changes, and also having a bit of a model out and remember, as investors, always thinking about the numbers and making your decisions based on numbers, not gut feel and the likes. So I hope that was helpful. If you are interested in having a conversation about your property empire and how we might help you on that journey, my details are up there. I'd be happy to take any calls from you, and we can talk about how we might be able to help you in the future. But yeah, I hope that was helpful for you guys. Thanks.
Anthony, I've got two questions here that came in directly to me, and I'll just, so one question is, are there any other changes coming in?
I guess in what respect? There is new tax law that's pretty much dished out to us every month. In terms of property specific stuff, I think this is the bulk of it, to be honest. The bright line and interest deductibility changes, and with that, the main home adjustments on the bright line test. Those are the core property changes this year.
Oh, lovely. Another one that came in is that, do you think there will continue to be growth in property?
Of course, my opinions are as worth as the person you speak to on the street. What I can say is that no one is very good at predicting where house prices are going. So I remember May last year, so just coming out of COVID, I was like, oh, it's going to hit the property market. Things are really going to take a turn, particularly as the wage subsidy income dries up. So I was like, oh yeah, September 2020 onwards will be pretty tough. And then we had 30% growth over the last year. So I don't think I'm the right person to ask, as is I don't think anybody like Tony Alexander is any better. It's a long-term game anyway. So trying to predict the short-term property market is not what being an investor is about. It's about that long-term plan. Why I put out the just that scenario of just actually looking at a new build versus an existing property is just to give food for thought for people. It doesn't complete these rule changes, certainly disadvantage existing property. But if there are other characteristics to that property, and I put out there subdivision potential, then it can still make sense on the numbers.
Yeah, and here's a few more that came in. So I don't know if you just want to answer Tanya's question in the box there.
Yeah, Tanya, that will be considered a new purchase. So you don't want that happening. There's that would re-trigger bright line test. Also, to backstory for anyone who hasn't read the chat, existing rental property, banks requiring the rental to be put into from a company into personal names. There are a few banks, usually some fringe second-tier banks, that won't lend to companies. So they often make you put in only properties in your own name. And she's asked, will that be considered a new purchase? And yes, it is. As the laws currently stand, the transfer of property from your company to yourself or yourself to a company is considered two separate events. It's a sale transaction. So you restart Brightline test or incur Brightline tests income. So not ideal. What I would say to that is part of these law changes is that a transfer of property from a company or yourself to, and vice versa between a related party won't be considered a sale transaction, but that doesn't kick in until 1 April 2022.
All right, and then I've got another one here. Tanya, I hope he's answered your question. I know she's an accounting professional as well. And then I've got another question here. If a major reno is done on an older house requiring a CCC, will the entire dwelling be considered as a new build?
No. So you need to add to the existing housing stock. So there needs to be a renovation in itself won't do it. I'm just trying to recall off the top of my head whether the adding of a new room even meets the criteria. I can't recall that one off the top of my head, but basically it needs to increase housing stock. So an existing property undergoing a renovation that required a CCC, it doesn't mean it's going to be classed as a new build.
All right, and then Sally just flicked the question through. I have an existing rental that I've held for 11 years with 80 square rumpus room at the end of the house, which I'm in the process of turning into a self-contained unit. It will have its own CCC. Will this new unit be a new build?
Hard to answer because it sounds like that rumpus room is attached to the existing dwelling. If that was a separate dwelling and then it became a self-contained unit, then you are adding to the housing stock. So I know in that scenario it would be yes. Because it's already attached to the existing house, come back to that point that I just made before, can't recall off the top of my head whether adding new rooms actually gets you over the threshold, and that would be that scenario there. So you kind of answered it, not really.
And then how long is interest deductibility for new builds? And does this stop if you sell or transfer to a new owner?
So it's 20 years and it transfers from owner to owner. 20 years from the CCC.
Okay.
That came out in just in September. So that was kind of news to everyone. We didn't know how that was going to play out. And after they did their back of the envelope tax law back in March, we were all kind of wondering what exactly it all looked like. And then we got the detail in late September, and in that they outlined 20 years of interest deduction on new build property.
All right, lovely. If anybody still has a question, you could please flick it through. I'll just give a few seconds for that. The great news is the whole presentation was pre-recorded, and I will be sure to get a copy out to everybody. So you don't have to see the views on my desktop that I showed you a few minutes ago. So I'll get that through to everybody. And then if there's no further questions, if you have any further questions, you can reach out to either myself or Anthony. Here's my details, contact details, my number, email, LinkedIn, and also our website. So if you require any further services, you can just get in touch. Further than that, Anthony, I'd like to thank you for your time. Thanks to all our members on, and I appreciate everybody's time. So I'll get the recording through to everybody. Anybody's got any further questions, hit it through to us and we'll get that. The smarter people like Anthony will get that answered for you.
Brilliant. Cheers, guys.
All right, guys. Thank you.